All right, folks, this is being recorded. I mentioned at the beginning of every single webinar, watch this again. Why? Because it'll help sink into your long-term memory. For one, you won't have to go back and review some of the nuances that we're going to go over in the specific webinar on the roadmap to trading options for the long put diagonal. Now, I'm not picking option strategies out of a hat on any given day. There is a certain time and a place for any given strategy, and that's what we're trying to do with this roadmap to trading options, is to follow this roadmap or this pathway to find the right option strategy. Kind of think of it this way: if it's high volatility, you take a right; if it's low volatility, you take a left, kind of thing, and it filters out into the right option strategy for any given assumption. So we'll talk about that from the standpoint of we've come up with an option strategy, or we've come up with a directional assumption, look at the underlying, and then find the right option strategy for that assumption. It's not going into any given day talking about I need to put on a long put diagonal. No, what we do is we go through a process to find that strategy. So that's how we're going to go through this webinar with that analogy in mind, okay? Let me get a couple of things out of the way real quick. My name is Eric Wilkinson. You very well may recognize me as the Wolfman from mainstream media, where I've talked about the economic data, the geopolitical environment, how that all comes in to impact the markets with some of my market analysis. And now what I'm doing is teaching you folks on how to find the optimal option strategy for your directional moves. So with that being said, I started out trading in college with some money I'd earned, moved to Chicago, and have been trading my own money ever since. Like I mentioned, we're doing this on the long put diagonal, but we're going to put this on the shelf for a little while. Why? Because we need to go through some of the nuances around these options in order to discern what kind of option strategy we want. But in this webinar, we're going to be talking about a few things here, and you will likely be clear a concept before we get out of here. But what we're talking about here is the first thing, any given day, we come up with a directional assumption, all right? This is our assumption, and that is on a move, whether it's positive, neutral, or bearish, right? Then with destination, this really has to do is XYZ stock. Is it, can we trade options around it? And we're going to show you how to figure that out. Is that destination, is that underlying options tradable? Environment, we're going to be talking about volatility. All right, that's the environment. This is one of the most important things to lead us to the right option strategy. Duration, we're going to be talking about days to expiration in the options, all right? We're going to be talking about specifics on that. And then finally, we're going to be talking about strike location, all right? Now online, yeah, they're going to tell you a couple of little things about where the strike location is. Well, they'll probably just give you that you're doing 2 different months with 2 different strikes. I'm going to be talking about specific deltas, all right? I'm going to be talking about the deltas we want to start looking at, and we'll be talking about how much should we be paying for this strategy. That's really what it comes down to, brass tacks, is knowing that when I find the strikes, yeah, we can talk about deltas, but if it doesn't give me, or if I'm paying too much for this strategy, I need to know, and I'm going to show you little tricks of the trade in order to find that out or figure that out. All right, so without further ado, let's talk about the roadmap key. Anytime we go on a road trip, we need to understand what we're looking at, right? The option montage can be like a flight simulator, folks. And if you are just looking at it for the first time, it can be intimidating. But I want to go over what these Greeks are really quickly and give you simple ways to remember what they are and what they do, what they stand for. So without further ado, let's get on with it. Delta is data, all right? It tells us all kinds of things. It'll tell us the probabilities of being in the money, the probabilities of being touched, probabilities of being out of the money. All of that is data. But one thing that we're going to really look at here is how does delta, that number, how does the delta number affect the options premium in relation to the underlying? Well, we're talking about a $1 move, all right? So a $1 move higher to be more specific. Now, All of the Greeks assume a couple of simple things. One is it's always an advancement, all right? So all of the Greek numbers that we're going to be looking at are assuming we're moving forward, we're moving higher, we're moving a day further, we're moving forward, we're not going backwards, all right? So that's never a thought on the option montage. We have to kind of add that methodology into it. But Delta tells us what's going to happen to our options premium in relation to the underlying. So immediately we're looking at the delta, and we can look at the calls, or the puts and the calls, I should say. But this is, like I said, remember we said $1 move higher. So $1 move higher, that would give us 149.35 if it was exactly $1 move higher. All else remains the same. We haven't moved a day or any, we haven't even moved a second, to be honest. And if we looked at, let's just go with the easy ones, 150 calls, and doesn't matter what stock it is, all right? That's why I blacked that out so we don't have to worry about it. All right, but if we're just looking at the 150 calls, we can see the strikes over here, and the delta column is over here, all right? That's the column we're looking at for this one. But each number is correlated to its strike across the column here. So, or actually it's a row probably, right? So 45 cents on the first dollar move, 45 cents goes into our premiums here. So on that first dollar move, we would see this move to 405 and to if we added 45 cents into here, that would be 420, right? So those move, as the underlying moves higher, our call prices move higher. Well, what do we notice over here on the put side? Well, the put side is all negative. That's because the assumption is we move higher. So if we moved higher, we would see our puts decrease by this 38 cents, all right? So then we would see these come out to being $2 and what is that, 62 cents on the bid, and $2.72 on the offer. That would be on a first dollar move higher. Now, think of it on the other side. If we move down by $1, if there was a negative dollar move, what happens then? Well, a negative plus a positive, so we have a negative plus a positive delta, that would make these deltas then negative, all right, if we started moving down. And over here, if we have a negative plus a positive, or plus a negative, negative plus a negative makes that a positive. So if we started moving down, we would see this delta add into those premiums, okay? Pretty simple so far. One thing to note, delta is bigger closer to the at the money, and as soon as the strikes go into the money, you can see they become very close to 1. Now, these are off a little bit because the markets are super wide over here, but one would assume that these would all stay about 1 across the board, okay? But the reason why it gets a little wanky is because the markets are a little bit wider in there. So further in the money, delta becomes bigger, closer to the 1. Further out of the money, they become smaller and closer to 0, as you can see over here to here, all right? So the at the monies are usually going to be right around a 50 delta. All right, so gamma. Gamma goes with delta. We talked about this being dollar number 1, right? Well, gamma goes with delta is the easiest way to remember it, and that's because it's dollar number 2. All right, so we already talked about dollar number 1 in regards to what would happen. Now, dollar number 2, we've got this little gamma number over here because we've got our gamma column right here, and you'll see that it is always positive. But the thing is, on the second dollar, we would see this 3 cents go into that, and then that would make it 48 cents, right? So on the second dollar move, our premiums would increase by that 48 cents. So we would go from 405 to 453, right? Adding 48 cents in there, and this would be 468. All right? So on the next dollar move, we could see that happening. Next dollar move higher over here, well, gamma's positive, we've got a negative delta, so we would only lose 35 cents from these. All right, so we would be looking at 227 on the bid there. All right, and then 237, I think, if I'm doing the math right on there. it would only decrease by that 35 cents, all right? Flip side, if we had gone down by $2, then on that first dollar move down, we would have seen 38 cents go in there, right? Because we had on a first dollar move down, a negative plus a positive, or sorry, a negative plus a negative makes that a positive. Well, we would see 38 cents go in on the first dollar, and on the second dollar, we would see that increase by 41 cents, all right? Pretty simple. Right? Everybody with me so far? I don't see anybody asking questions. All right. Theta's our thief. The thief in the night that comes and steals our premium every single night. All right. Now, theta is going to be negative. Why? Because every single night, theta comes in and steals premiums. You can see in the puts and in the calls, we've got theta as a negative. That's because we can't go back in time, folks. Every single day, premium is going to erode out of our premium, or the theta column is going to erode out of our premium. So tomorrow we would wake up, and if all else remained the same, XYZ is still trading exactly the same place, and the only thing that happened was one day went by, we would wake up tomorrow and see our premiums lose 6 cents. So we'd be looking at 354, right? On the bid, and 6 cents out of here would be 369. So tomorrow we wake up, we would see our premiums just decrease on both the calls and the puts by that corresponding theta. Now, the closer and closer we get to expiration, this theta number is going to get bigger and bigger. JP, cannot see your screen. Anybody else having a problem seeing my screen? It looks to me like it's on there. Anybody else? We are fine. John, if you ever have a problem, best way to do this is to flip out and come back in. But it seems like everybody else is seeing what what I'm showing here with the option montage page. Are you seeing it now, John? All right. So what was I saying? Where was I? With the theta, thief is more and more aggressive the closer and closer we get to expiration. Way out in time, he doesn't even really know you exist. He's barely even bothering you. But the closer and closer to expiration, this number will start increasing for the exact same puts and calls. All right. So you would see that number be a lot bigger on the closer to expiration. We'll show you a couple other examples anyway. But just remember, theta is less aggressive, further out in time, more aggressive, closer to expiration. And the sweet spot for theta to start picking up steam is inside of 35 days to expiration. That's really where we start to see that ramp up. All right, Vega is just vol. So I'm just going to write vol like that. You know it's volatility. I almost never talk about volume on trades necessarily, but it's the measure of change in volatility. So that little number is pretty simple, right? We've got our Vega number right here on the call side, our Vega number over here on the put side. All this is implied volatility, if you guys have ever heard that. So that is what we look for when we're talking about volatility or Vega. All of those are the same. Vega, volatility, and implied volatility. A lot of people use the same, or it's the same word for, same words for the same thing, volatility. But we're talking about implied volatility specifically. All right, so Vega is always positive because the assumption is volatility. This number would start increasing. So just like all the rest of the Greeks, it's the assumption of a move higher or an advancement, and it's by increments of one. 1 day, 1 percentage point, $1. Okay, so this would be an increase of 1% on this. Increase of 1%. Now we're talking 27.57 on the implied volatility. So if implied volatility increased by that 1%, we would see all of our premiums increase by the corresponding Vega. All right. So that's the column we would be looking at on this Vega. So if it increased by 1 percentage points, nothing else happened, the underlying didn't change a penny, we would see the Vega increase these premiums to 318 on the bid and 328 on the offer. All right, see how that just goes in there? And on the flip side, we would see those same 150 or the 150 puts we were looking at on the calls over here increase by that 19 cents. So we would go to 379 on the bid and 380. No, sorry, 394 on the offer there. So those premiums would just increase by that corresponding volatility coefficient. All right. So as volatility increases, the premiums increase. And that is going to be a storyline that I'm going to keep talking about, folks. Is as volatility increases, the premiums increase, even if nothing else happens. And volatility can affect these premiums more so than anything else out there. Okay. Volatility doesn't just usually move in one tick increments. It moves in 2, 3, 4, 5, sometimes 10 tick increments. So you can see that if it increased by 1%, it increases by 18 cents. Well, think about it. If it increased by 10 percentage points, it would increase by $1.80 on these puts. All right. And if it decreased by that much, we could see the decrease in those premiums. So ultimately, volatility determines the options premiums more so than anything else. So we need to really be hyper focused on what volatility is doing to those premiums, right? Because if volatility has pumped up those premiums, we know they're super expensive. And when volatility is really low, then we know that those premiums are cheap. And just to go a little bit further, I'm not talking about the VIX in this particular example. I almost never look at the VIX to determine whether or not premiums are expensive or cheap. I actually don't do that. I look at XYZ's implied volatility right now, its current implied volatility in relation to where it is in the last 52 weeks, basically. So, and we're going to go over all of that. I'm just giving you guys some broad strokes right now. Let this sink in. We're going to touch on these a couple more times as we go along here. And by the end of it, I'm hoping that you guys will have a clear concept of what's going on. All right. Yes, we are now getting into the nitty gritty of the long put diagonal, but we don't know we're doing the long put diagonal at this point. Why? Because we have to come up with our directional assumption first. So what we do is we're flipping through the charts and we come up with a directional assumption for whatever underlying we're looking at. In this case, I'm looking at Gilead. All right. So Gilead has had a nice run to the upside, but my thinking is that we're going to trade kind of like that, and Gilead's going to lose a little bit of steam. I think that they are out of the running of all of this COVID stuff. They're losing a little bit of hand in that arena. So I think that they're going to start losing a little bit of momentum, maybe trade sideways right around in this area here, which would be fine. But ultimately, I believe that the market is going down. But I don't think this is going to happen. But what if it does? I want to limit my risk to that upside because, yes, they could come up with the best in class for some kind of response to COVID. So that would then give them a bunch upside. But I want to limit my upside on it. I don't think that that's going to happen. I think it's going to go to Johnson & Johnson or somebody else. So therefore, I think we're going to trend sideways here and then come off a little bit over time. So I've got my directional assumption. I'm worried about the bullish side. I don't think it's going to happen, but I am worried about it. So I want to limit my risk. I want to limit risk to the upside. All right. So I know that for a fact. I believe that we are actually, this is the one that I'm really going for. I think that it's going to be more of a bearish move. But if it trades sideways, I'm not going to be overly anxious or upset. But long-term bearishness, I don't care in the near term what it does, but ultimately over the course of time, I want to take advantage of a downside move here. So we've got, our directional assumption. We're going to kind of take our roadmap. This is kind of like what we think was going to happen, right? With the trading. So I've got my roadmap figured out. I got my path kind of charted. So now I need to figure out, is this underlying that I'm looking at, Gilead, a good destination? Meaning, is there a lot of eyeballs on this destination that I'm going to go to, right? you know, because when we're planning a trip, we don't want to go somewhere where there's nothing going on for the family or even ourselves. We want to have a lot of things to do, places to see, places to go to eat, whatever you do on your vacation. You usually like to be surrounded by at least something to do rather than watching a yellow light blink in a one-horse town. So what we do by that in the option montage is really dig down into the premiums that we're looking at here, okay? And the spot month is the key one to look at. Yes, we are going to be trading out here in on the time horizon with this type of strategy, but to figure out whether or not this is options tradable, we really look at the spot month, which is the one that's going to be closest to 35 days to expiration. That's where all of the eyeballs are. And yes, you can click on this little tab up here and drop it down, see volume and open interest. You can kind of get a pretty good gauge there as to if there's a lot of people transacting, if there's a lot of free market price discovery going on, and that's ultimately what we're trying to figure out with this. Is it a good destination? Is there free market price discovery in full swing? And, you know, volume and open interest doesn't always correlate to there being a lot of participants watching this market. But having said that, an easy way to determine whether or not the markets are tight is any stock in Gilead we're looking at, it is less than $100 stock, and just stick with our theme of a roadmap or roadmap trading. We've got a stoplight. So on a stock that is less than $100, so this is less than $100, 66, right? So stocks less than $100, we need our bid offer, the bid offer, to be less than or equal to 10 cents wide. All right. So then we kind of look down here. Well, we've got one that's 11 cents, but for the most part, we can see from the bid offer on all of these, on the calls and the puts, are pretty inside of that. And therefore, I'd say that that is a green light. The yellow light would be 2 times the rule. All right. So 20 cents wide. And if it's less than $100 stock and it goes over 2 times that rule, it is definitely a red light across the board. I would not do it because those markets are too wide to get involved in, especially when you're, if they're really wide in this front month, they're going to be even wider in that further out month. All right. So we want to make sure that we have tight markets because we're doing a multi-month type of strategy here. So we don't want to get involved in something where we have to be the person coming up with the free market price discovery. So any stock less than $100, we want less than or equal to 10 cents wide on the bid offer. Now, if it is, I zoomed in on this just to give you guys, in case you were having trouble seeing it, but you can see this less than 10 cents wide is the rule for this on the option montage. We can see that that is working out quite nicely. Now, if it's a stock that's over $100 and sticking with its roadmap theme, you know, we've got the stoplight on a stock that is over $100. What we want to do is move the decimal 3 ticks to the left, and that would equal 21 cents, right? 3 ticks to the left, 21 cents. Check that with the option montage, closest to 35 days to expiration. And you can see that we are fitting that rule pretty good across the board in this underlying. So that would be a green light, you know, fitting the rule. Yellow light, 2 times the rule. Again, all right. Anytime you're getting to 3 times the rule, you know, as a red, just walk away, folks. I mean, seriously, there's nobody in there trading, and you're gonna have to give up a lot of edge. If you had to give up that much edge, 60 cents to get in, then if you have to give up 60 cents to get in, right, which would be 3 times the rule, then you're going to have to give up that 60 cents to get out. So we want to stay away from that, because that giving 60 cents up to get in, 60 cents up to get out, I mean, literally, you've given up $1.20 in edge. All right, that might be your entire profit margin. So stay away from that. What program are you? Aggie's asking, what program are you using? You're talking about this platform is Thinkorswim. Thanks. I was having trouble seeing the bid ask. Are you seeing it now? Oh, with this on the zoom in. All right. I meant to do that. I had a feeling people were going to have trouble with that. which is why I did the zoom in and forgot all about me putting that on for the zoom in on the bid ask. But you can see that that one's 20 cents. That one's inside of that. And is that on Verizon? Oh, I'm not changing. There you go. So you can see that these are inside of that, except for that one market. But for the most part, we can see we are very close to inside of that 10 cents there. All right, so the next thing we want to look at, we already figured out that Gilead fits my rule for tight bid ask, less than 10 cents wide to the bid ask. That's a green light to trade Gilead around my neutral to long-term bearish assumption. All right, so the next thing we need to, I've come up with my assumption. I realized that, okay, Gilead, I can trade options around it. There's a lot of people in there trading that. I'm good to go there. Now, I need to discern whether or not we have volatility. Is that high or low? And when we think about it, like on a same thing with the roadmap mantra, is low volatility, sunny skies, not a care in the world. You know, you're not white knuckling it. You can see the roads really easy. When it's rainy, you're getting a little bit stressed, right? There's a higher elevation of stress. That's kind of like that cloudy. You're white knuckling it through the drive. Maybe it's snowing, raining, whatever. So how do we figure out if it's got high volatility or low volatility in the overall markets? Well, we look at implied volatility. Remember I said volatility is the determining factor of the option montage pricing. So what we can tell with underlines is that they have a tendency to stay in like a range bound area. If we're looking at that red line in the sand out to the right here, you can see that it has a tendency to stay within a range bound area. Yes, we had a crazy time going on at the beginning of last year. All right, something to note about that volatility where people are saying, okay, no, volatility can spike like that. Yes, it can. I'm not going to take that away from it at all. Yes, it could spike back to those levels again. Any of the markets can. Well, having said that though, if we take this and relate it to what has happened in the past, the last time we saw volatility spikes like that was like in 1987, folks. It wasn't even during the financial crisis. So most people trading today haven't even seen that kind of volatility since 1987, okay? And before that, it was like 1929. So we on the floor would call this a black swan event, where it is so bizarre that it's just not going to happen again probably for another 5 or so years. Well, having said that, then I'm not really in that time horizon. I'm not worried about that far out. I'm not even worried. I'm not even thinking more so than a year most times. So what we are going to do is find that we have a range bound. So 32 for Gilead may be relatively low, but that could be absolutely something that is never heard from in, say, Tesla. It never gets below 50, okay? So we have to look at each underlying and see where its current implied volatility is in relation to the high and the low, okay? Because when it's near the low, we can see that it's in a range bound. We can make the assumption that those are really cheap premiums. And when it's near that high, we can say that those are really expensive premiums. Yes, it can continue below this line and above this line, okay? But what we're trying to do is ballpark what those premiums are, whether they're expensive or cheap. And one could say, or I would say, that it is below the mid mark here, okay? So therefore, I would say that they are relatively cheap premiums in the option montage just by looking at this implied volatility chart. So I can assume that there's low volatility for Gilead, at least right now. And why does volatility matter? Because we talked about this a couple of times. Volatility tells us if volatility goes up, so do the premiums, right? So do my premiums. They start going up, all right? And as volatility goes down, well, then our premiums go down. It's pretty simple. And when we're looking at that, well, we know if volatility is high, we sell those premiums. And when volatility is low, we buy those premiums, okay? So if we look at this option pay, or this chart page, always look for this implied volatility in your charts, because I have this on every single chart, because that is when I'm flipping through the charts, I can look straight down here and say, all right, premiums are pretty cheap. That's the easiest way to figure this out. All right, just kind of ballparking it. If you aren't really too head over heels over trying to figure out the premiums on these things, if I look at this on toss right now, it's going to say that my implied volatility percent is around 7, which means that's really low, but it's also taking into account this high and this low, which I don't necessarily think we're going to see that high or that extreme lows that we saw back before the pandemic. So you can find this on toss or most platforms pretty easily. I have, if you have toss, I have the script to throw it over here in the watch list. You'll see that I have implied volatility percent over here. It gives I can get you guys the script for that. Another place you can find it is over here, implied volatility percent. But again, it's taking the math into account for that extreme high over there that I want to take out of the equation. So if you love the minutia and figuring out the math, what we would do is we have we take the current implied volatility, that's this number right here, right? Current implied volatility minus the low. Take that sum and divide it by the high IV minus the low IV. All right. And you don't have to have the exact to the dot number, but if you want to really dig into the details, you can, find out that exact dot. I'm going to go with the current is 32, the high is 50, and I'm going to say the low is going to be right around 20, let's just say 26. So the current is 32 minus the low of 26. Take that sum and divide it by the high of 50 minus the low of 26. All right. So basically we've got 6 divided by 24, right? So 6 divided by 24 is going to basically give me, I should be able to do this math in my head really easy. That's 20%. Is that right? I'm having a brain cramp right now. Somebody throwing it out there. 25%. Thank you. Yes, 25. Right. A fourth of 24. 25%. So it is, below the 50 mark. Now, for my general rule of thumb, I say less than, a 50% here on this number here. Okay, less than a 50 percentile is basically, you're buying premium. And if it's greater than a 50%, you're looking to sell premium. All right, that's the general rule of thumb. Now, if you have a lower risk tolerance, you could say less than 30%, I'm going to be looking to buy, because then you're looking at extremes. And then greater than 70% is where you would be looking to sell. You wouldn't do anything in between for the most part, unless you're trying to offset everything. Thank you. Everybody's blowing me up. I had a brain cramp there. It should have been easy. 4 times 6 is 24. 25%. Easy. Easy peasy. Okay, so you guys can use either one of those. This is for a lower risk tolerance or a very new trader, all right? All right. But we've got it fitting the rule for a higher risk tolerant or a newer trader. So in this regard, we would know that the premiums are extremely cheap. But I have no problem, you guys, just kind of ballparking and saying, okay, there's anything, this would be, greater than 50, right, above here, and this is less than 50 below. If you just wanted to ballpark it, I have no problem with that. So we know we have really pretty cheap premiums going on in Gilead. All right. Now, another thing we have to look at with this strategy, because remember we talked about in the very beginning that we're going to be using different months because I've got a medium to bearish short-term outlook, but a long-term outlook is bearish. All right. So I've got a long-term bearish outlook. We've got volatility really low. We know they're pretty cheap. Now, what we have to also look at is, because we have different months, is the Vega coefficient in the two different months. Now, we can see that volatility actually is lower here in this option. These are lower, right, than these. See this number here? It's 3285. This is 31, so it's lower. Anybody have any idea what that implies about our premiums right now? That these options that are closer to duration are pumped with more volatility than these are. So in a sense, these are more expensive than these. All right, which works out perfect for this one. Because I'm buying out here, because I'm going to be looking to buy out here and sell here. So that's a great scenario where I'm buying cheap and selling a little bit more expensive in the same option montage. Now, I will tell you, folks, this is a rarity. You rarely see the volatility drop. Sorry, I accidentally touched my my Wacom screen. Usually, this number will be higher, okay? That number will be higher, usually increasing. So with that being said, my rule here, sticking with that whole theory of the idea of the option montage and the roadmap, I guess I should say, actually. I want the white. All right, so usually it increases, okay? We've got that out of the way. This is decreasing, so that's obviously a green light. But my rule for a green light, if we were going to be talking about a green light, is that it is less than a 3% increase in implied volatility. All right, less than a 3% increase is a green light. 3 to 5% increase, that's going to be our yellow light. And if it increases more than 5%, is greater than 5%, then big old red light, don't do it. Why? Because we would be selling up here and buying really expensive premiums out here. Okay, we want to avoid that. So we want very little increase. And in this case, we have a decrease, so we're fine. But we want less than a 3% increase on these options, okay? Does that make sense for everybody? When we're talking about volatility, there's a couple of things that we have to look at. We need to make sure that our volatility here is less than an IV percent of 50. That means we're leaning towards buying, right? So that's one of the things. So we know we're doing a debit spread. Now we know that we have a great scenario where we can buy out here and sell here. Buy cheap, sell a little bit more expensive. That helps us out with this spread because of that volatility being lower further out the curve, which is a rarity. So that's why, another reason why I want to take advantage of that in this low volatility environment. So what kind of duration do we want to look at? Well, a couple of things to ask ourselves when we're tell ourselves that we've talked about here. When you're buying an option, you want to limit theta decay. Well, I'm going to be buying an option further out the curve then, right? And when you're selling an option, you want to exploit theta decay. So when you're selling options premiums or you're selling an option, you want theta to be in your favor. So how do we work that out? Well, volatility, I told you, the closer to expiration we get starts ramping up. And this is a representation of the at-the-money is what happens to the premiums. Well, remember I said that 35 days to expiration is the sweet spot? That's because inside of this, for 28 days, we see a 50% decrease in the premiums due to theta, all right? 50% drop in the premiums. Out here, you can see it's the slope is a lot less than in here. So we're going to be bought. We want to buy out here and we want to sell in here. And that's generally speaking for any option strategy, folks. If I'm selling a call spread, I would want to do it in here. If I'm buying a call spread, I would want to do it out here. Well, I'm doing a diagonal. So I want to sell within this area, my option, and I want to buy out here in this area, okay? So this is where I would be buying my put in this case and selling a put because I've got a directional bearish assumption. You're buying puts to be that directional bear, right? So we've got a couple of things figured out there. Now we need to understand what kind of vehicle are we going to use. Well, this is where we pull it off the shelf. It's a long put diagonal, a medium to short term, neutral to bearish short term outlook. We don't care if it moves down a little bit. Want to limit our risk completely to the upside if this underlying takes off for some reason. We want to limit that, have like a synthetic stop embedded in there. Now, remember, with options, when you have these two options, we are defining the risks, all right? Because we have to figure out what kind of spots are we going to vision. Well, we have a short out of the money put here. That's going to be in the nearest expiration. This is what you're going to find online. They're going to tell you this exactly. And a long, this should be out of long in the money put in the further expiration. That's going to be a little bit different than what you might find online. They don't always say this, but for the diagonal, I like to have my long duration put in the money, okay? For this one, in that further expiration. That I limit my theta decay out here, and I exploit my theta decay here, right? And in this case, I'm also selling high volatility here and buying low volatility out the curve, right? Now, I told you I was going to give you guys the strike locations. And really what we're looking for in that further expiration is right around the 84-ish, all right? I always say ish. Why? Because sometimes it's going to be like the 86 or the 87 delta, all right? But we start out around that 84 delta and then look to see where we can sell as close to that 36 delta as we can. I've got a couple other rules that we'll talk about here for this 84 delta that will help us figure it all out. But ultimately, our Analyze tab will show us this, our risk to the downside during the life of this option. If it goes down, we have a max profit during the life of our short option contract here. All right, that's what's really determining this. All right, the flatten out. That's when our short call defines that risk to this downside, right? And you can see we have limited risk to the upside here if the market takes off to the upside because I am long a put. If the market rallies up, I don't have any risk above that. That's this 80 strike, okay? There's no more risk above that 80 strike for me. But during the life of this option, I have a max profit here. If I let this short strike expire worthless, then if I let this short put expire worthless, then I have this curve will continue to go off like that, all right? It will continue to show that I can make more money there. Trevor's asking, why are we using the 84 delta? That's a great question. So a couple of things that we want to talk about here with that. I'm just about ready to touch on that as well, Trevor. So perfect timing on the question. So let's just pull up the option montage again. So Gilead, we're looking at the May. I told you I wanted to get outside. I like to be outside of 70 days to expiration on my long strike. Now, I want to go at about the 84 delta-ish on this Gilead trade. Why? Because I want to try and pay off the extrinsic value of this underlying. So usually the 84, I don't like to do the half tick. So I'm going to, in this example, try and cover up because the market did move since I started pulling up that example. So let's go through this process, what I would look at. Gilead, all right, I've already discerned, all right, less than 10 cents wide to the bid offer. It's after the close, so it's going to be a little bit wider, folks. Make sure you check this during open market operations. All right, so I know I'm going to do this, the long put diagonal. So I've gotten all that figured out. I can see that that's tight. I see that the volatility coefficient decreases even more now after the close, but that's because the markets are a little bit different. So I'm going to be looking at the May, and I'm going to try and go at around the 86 delta. You can see I don't have an 86 delta, so this is the closest one I'm going to be able to find. This is probably the 86 delta. You can see that the delta should increase there as we go down. But here's the first step we do. We kind of pick that 86-ish delta. All right, so I've got this. I'm long. I want to look over at the corresponding calls because that's what I need to pay off on the extrinsic value of that. That's a little trader hack for you. Yeah, you can figure out the math on it, but easier just to look across at that. And then, so I got to think, all right, I got to get at least 80 some cents here to trade this. And I'm going to go with the halves, for lack of a better one to be able to do. All right, so the next thing we need to do here is figure out whether or not we want to make sure we are paying less than 75% the width of the spread. So I'm just going to round it up to $14, $13.96, and divide that by the width of this spread, which is 17.5, divided by 17.5, and it's 80. Before the market moved, it was working out pretty good. But I would want to make sure that this was closer to 80. Let me just see what happens if I go a little bit wider. I've got 1450 divided by 20 now. $14.50. Oops. $14.50 divided by $20 wide. And that makes it less than 75%. So I'm paying less than 75%. This is the one that I would go with. And it will give you basically the same setup that we were looking at in the Analyze tab over there. I don't know why that's not showing up there. Oh, that's an old thing. All right, so basically coming up with the same thing I came up with here during the day session. 1472 divided by that 20 gives me that 72 percentile. Trevor, did I answer your question there? If you do the 50 delta, you're basically not going to be able to get to 75% and pay off all of your extrinsic value. So that would be our green light, following along with our roadmap. What do I want here? I want this. So, you know, going again with the stoplight, less than 75%, less than 75% the width, right? The debit pay to 75% the width. That's green light. Basically, yellow light is going to be 75 to 85, and I wouldn't even do this, to be honest with you, but if it's 75, that's your yellow light. Anything greater than, greater than 85%, just walk away. All right? This is really what you want. 75% the width of the strikes. That's, or less than 75% the width of the strikes. Okay. Everybody got that so far? All right, little review. You guys got this with the directional assumption where it is short-term neutral to long-term bearish. That's going to be a great one for the long put diagonal. That's how we used to draw it on the floor. Our destination, we check that off, right? That is on a stock that is less than $100, it's got to be the bid to the offer has got to be less than 10 cents wide. If it's greater than $100, right, then we move the decimal 3 ticks to the left, all right? Environment, we want low IV, and we want less than a 3% increase in implied volatility, right? Where that beta is. You can look at that as, keep touching the screen there, sorry. I've got a little mouse thing on the side of my Wacom. And less than 3% increase, and less than a 50% IV, applied volatility. All right, percent. All right, our duration. We want our long put to be greater than, like 70 days to expiration. And then we want our short put to be, less than or equal to or as close to 35 days to expiration as we can. Why? Because the one that we're short, we want that theta decay. The one that we're long, we want to limit that theta decay, right? Also, the beauty in this, that long duration option, remember, we're buying that one. I said if volatility expands, it's going to expand faster in those further duration options. Well, that will even help us out further in this strategy. The strike locations, the further duration, we look to the 86-ish delta, 84-ish delta, somewhere, right in the mid 80s. All right. And then we look to pay off that extrinsic value with the short put, right? I looked over there, you saw me flip over, needed to get off about 80 some cents on a ballpark. That's how we're working that out. All right. Now our max profits are a little bit wanky, but our max profit is the width of the spread. This is during the life of the strategy. Width of the spreads minus the premium. In our case, we were looking at the width of the spreads were $20 wide, right? Minus the $14, and I'm just going to call it 50 cents. So my max profit is $5.50. Okay, that would be my max profit. Now, my max loss is that premium paid. We're paying $14.50. That is my max loss in this case. Pretty simple. Anytime you're paying a debit, that is your max loss. Now, our break evens is the long put strike minus the net premium on this. So we were looking at our long put was the 80 put. We're looking at the net premium of $14.50, right? So we're looking at basically $65.50. Let me do my math in my head real quick. Yes. All right. So my break even is when the underlying is trading at $65.50. Now, something to note with this underlying, we can go back to this chart here. You can see that when I set this strategy up, that it was trading right around where my break even was. So the break evens are very tight usually with this strategy to where your underlying is currently trading. A lot of times you're going to be able to get this strategy where you are getting short, in a sense, this underlying higher than where it's currently trading. So that is ultimately what you would really like to do as well. But you can see that when I built this out, it was very close to being in line with where the current underlying is trading as my break even. Now, we know our max profit, right? We talked about our max profit. We talked about our break even. Sorry. We talked about our max profit, $5.50. Max loss is that $14. We figured out where our break even is. Now we need to figure out our exit strategy, all right? First thing we need to do with any strategy is figuring out our exit strategy. And we are taking the long put diagonal, right? And we've got our strikes. We're doing the Feb, March, I think it was the May 80 puts. We're getting long the May 80 puts, and then we're getting short the Feb 60 puts. And that basically we did for a $14.50 debit, right? All right. So on a winner, I'm looking at 50% of max profit, all right? Well, my max profit was $5.50. So now I'm looking at $2.75 is my max profit really for this trade. So when it's trading $2.75 plus that, so when this underlying is trading $17.25, that is my exit. All right. When the debit increases to $17.25, I'm getting out. And that is likely going to happen if we go down and hit our short strike of the 60 puts during the life of this strategy, okay? If it doesn't, and this 60 put expires worthless, then what I'm going to try to do is roll this 60 put out in time and further away. So like to the 50 put or something like that. That increases the width of my spread. I collect another credit, increases my max profit, all of those things. Also increases my break even. So that's what we're trying to do with this strategy. Now on a loss, I would look at it like, hey, a 50% decrease in the debit, you'd get out. So in this case, we were looking at 14. So basically $7.25 to the downside is where I'm going to look to exit on a loss. All right. So get out that way. A lot of times I will tell you when I'm doing debit spreads, I will let those probabilities play out in my favor. If anything ever changes, you guys, if you ever wake up and you're watching the news and all of a sudden something changes about your directional assumption, do not ever hesitate to cover that trade. All right. You get that gut instinct to say, hey, I should probably get out of that. That's probably the best time to get out of it in my 25 years of history trading. Anytime I've had that light bulb kind of go off and I've had to think, that was usually the best time to get out. So don't ever kind of go back and like look at the charts or whatever and all of those things, talk yourself out of it necessarily, okay? I always like to say go with your gut. If you're not comfortable with it, get out, because otherwise you start breaking down on your mechanical trades and stuff like that. You'll start getting too emotional about it. Any other questions on this? Easy, just figure out 50% of max profit. If I can let this Feb expire worthless, I'm going to let that happen. I'll probably roll that out to March. You know, if it expired worthless, look to roll out short put. All right, roll out that short put if you can. All right, just like I do. And if you guys watch the daily market commentary, folks, I've been doing this like I've been putting on a clinic with covered calls as well. So this is the best way to increase your yield: is play these short puts, short calls against the long position, short puts against the bearish position. All of those things increase your success that way. All right, this strategy, we're coming out of earnings, is a great strategy for earnings, you guys. So here's your earnings offer. This is in the chat window over there. So if you want to just click on that hot link, it'll take you straight to this. There's over 10 hours of my favorite option strategies for trading options. I talk about exactly when, where, and why we would put these on. I mean, specific times of the day in order to implement an earnings trade. Also, when that earnings cycle comes past, you know, like Visa's already come out with earnings, we can set up for the next earnings trade using some of these strategies like the diagonal calendar. But I have specific rules for all of the options for earnings, and I go over that in this strategy, and you'll be able to spot those option strategies for the best moves. All right, and take advantage of that. A lot more goes on in there. I can't list all of them right now, but if you click on that link, you'll be able to get it. If you're watching on tape delay, you're going to have to pause it. For 36 bucks, you guys, that if I can save you making this mistake of buying a call before an earnings, that is well worth the tuition, because you're going to lose more than $36 on that. All right, again, here is the link up here in the URL. This is what you guys are going to get, the options earning seasons webinar. All right, that's all I got for you guys. Again, the course link here. If you have any questions, comments, or anything else, you want to reach out to us, 310-598-6677 or trading@protraderstrategies.com. Finally, yes, we have a disclaimer. Please take a moment to go over that, as we're an educational company. I'm not trying to get you to do these trades that I've even talked about in this webinar or in my daily market commentaries. I'm just trying to show you guys how I've been trading over 25 years successfully with my own money. So, you know, it's working, but there is the possibility of losing money no matter what you are trading, folks. It doesn't matter. But click on that link and I'll help you limit some of those problems you've had in the past. All right, that's all I got, folks. Like I said, take advantage of this. Thanks for all the participation. Appreciate it, y'all. And if you got the camera still up, you can't take that. Take it easy. That was a good hit. Take care, Alexander. Appreciate it. Appreciate all the kind words, everybody. You're the best. Appreciate it, OM. Thank you. Bye for now.